Good afternoon, everybody. While people are still logging in, I thought I'd already kick off. My name is Thomas. It's very good to be with yourselves. Thank you for taking the time to attend our webinar today. Today, we're going to be providing you with a couple of back-to-school insights, a tongue-in-cheek title to say that summer is over and we're back to work and we have to get back to taxes. While I appreciate that potentially a lot of you over the summer maybe have not had their eyes on the legislation coming out to different laws and whatnot, we've tried to make that easier for yourself, and therefore we will be discussing today updates primarily from the UAE, as it's the historically the most active jurisdiction, but also Saudi Arabia, the wider GCC, and then international as well. We will leave time as well for Q&A at the end of the session, so feel free to save your questions for then. We will be with you for approximately a bit longer than 1 hour. We have no other speakers today, so it'll just be me. I hope that won't be too monotonous for yourselves, but here we go. Let's go into every single country. As mentioned, what we've tried to do is, since June, there's been a lot of decisions that have come out. What we've tried to do for yourselves is try and distill what are the most important ones, what are the most impactful ones, and what could be really the most relevant for all of yourselves. I think starting with something that you may have seen already over and over in whether it's in webinars, seminars, and maybe online as well. And I hate to bring it back, but it is also incredibly important. I will not dwell much on the QFZP regime, the qualifying free zone person regime, allowing free zone persons to earn 0% corporate income tax on their income. But safe to say that there's a couple of points that we need to remind ourselves. What you see in front of you are the so-called gateway conditions for claiming the 0%. And you'll see there that a free zone person needs to have adequate substance in the free zone, earning qualifying income, which we will redefine again in a bit, comply with TP principles and maintain TP documentation, and not elect to pay corporate tax at the rate of 9%. What we sometimes add here as well is the requirement to have audited financial statements. When we look at a qualifying free zone person and the types of income that free zone person earns, if the qualifying free zone person doesn't meet the gateway conditions, it's considered as a mainland entity, and therefore its taxable income is split up between the profits up until 375,000 dirhams taxable at 0%, and any profits in excess of that taxable at 9%. When you look on the left-hand side, we look at QFZPs that do qualify, that meet the gateway conditions. They need to go and split up their income depending on who they earn it from or what situation they earn it from. And there, generally speaking, we would divide it up into 6 buckets. The first 2 ones being the income that you either earn from another free zone person in the same free zone or another free zone. The income earned from a non-free zone person, which is any person in the mainland and in a third country. To then distinguish further immovable property depending on its location, if it's located in a free zone, if it's commercial, and if the income is earned from another free zone person, it's subject to 0%. But any situation except for that is always subject to 9%. And then finally, PEs, both domestic and foreign. We have quite an interesting regime in the UAE where free zone entities can have a domestic permanent establishment to which we need to then allocate profits. You'll probably have seen also a variation of this graph multiple times over the course of the last couple of months. But just to bring in focus a bit to the left-hand side again, where for free zone persons who earn income from other free zone persons, we only need to review the list of excluded activities, whereas when we earn income from non-free zone persons, we have a list of excluded activities and of qualifying activities to be reviewed. When income is earned from an excluded activity, or from a non-qualifying activity, we can still be helped by the de minimis threshold, which we refer to as the 5 and 5 rule. And if your income, which doesn't qualify or is excluded, is only ancillary, really is relatively minimal compared to the overall revenue, then you can still claim as an entity fully the 0% on your qualifying income as a qualifying free zone person. Do you cross the line, then you are fully subject to corporate income tax at the rate of 9%, both for the current year and the following 4 years. This news obviously dates back to the 1st of June. We will make our way up to more recent news, but I think it is also important, and it will remain important for the next couple of years. In front of you, you see the list of qualifying activities, which is obviously important for the purposes of earning income from a non-free zone person. The list of excluded activities, which is important for all income. And there actually what you see is that when you look, for example, at the list of qualifying activities, what we are favoring is manufacturing and processing within a free zone. We favor holding companies in a free zone. We favor anything that relates to the shipping sector as well as reinsurance and also fund wealth and investment management services. To then go to something very important for larger groups, which have their head office in the UAE or regional head office, where headquarter, treasury, and financing services to related parties are also qualifying activities, as well as aircraft financing, logistics, distribution, and ancillary activities. I'll get back to a couple of those in a bit. There's also excluded activities, and those excluded activities, as the call out says, they're relevant for all types of income. And there, what we see is that transactions with natural persons, with certain exceptions, for example, with wealth management, are excluded activities. But so are more traditional financing activities, such as banking, insurance, finance, and leasing as well. That's perhaps a bit more surprising. As we saw on the previous slide, certain types of revenue from immovable property, and also importantly, any income which you earn from intellectual property is also an excluded activity. Those two lists also have a category which is which says that ancillary activities would follow also the tax regime of the main activity. That is sure to be an item that will be discussed quite a bit. An observation that you can make when you see those two lists is that it's relatively complex, that we do not necessarily have a 0% on export income from third countries. You may regret, for example, that services such as legal services, accounting, admin, tax services, that they are not included in the list of qualifying activities. Therefore, many of the free zone entities will be disqualified from being able to claim the 0% on their corporate income tax, and the rationale sometimes for some of these activities is a bit unclear. What you do see is that certain of these activities that they, for lack of a better word, they smell a bit like the definitions in economic substance regulations. And some of the activities haven't been defined also in the ministerial decision and the cabinet decision on the free zone activity. So we need to see a bit how this will evolve further. The excluded activities and the non-qualifying activities, they can be earned up to a certain threshold, and we call it the 5 and 5 rule. Why is that? It is because as long as you stay below 2 markers, you'll be able to continue to apply the 0% on qualifying, the 0% overall for a free zone person. And that 5 and 5 means that on the one hand, your income from excluded activities or non-qualifying income cannot exceed 5 million dirhams on an annual basis, or it cannot exceed 5% in your overall turnover. When we say overall turnover, I do need to note that that overall turnover is not the overall turnover in your financial statements, because certain types of income can be excluded from that, such as, for example, the income which is earned from a mainland permanent establishment. The disqualification, as mentioned already before, leads to a 5-year long loss of the benefits of the regime. An important point is due to the delegation of powers in the legislation to the cabinet and to the Minister of Finance, we can expect the Minister of Finance to legislate quite a bit on this matter. And what that means is we will likely have a very mobile regime with very often changes. A couple of points that we noted in the Ministry of Finance awareness session, which took place back in June, is that the Ministry of Finance had stated that in order for goods to qualify, or an activity to qualify as an activity of distributing goods, that the goods do not have to come physically to the designated zone. And that is actually not what Article 2.3 of the ministerial decision says. So we would expect that the Ministry of Finance will still change the ministerial decision. And the second thing that the Ministry of Finance had said that there's no public list of eligible free zones for the 0% UAE corporate income tax. But in the latest FAQs, they have said that each free zone authority will confirm the application of the regime for entities which are licensed in the free zone. A very important matter happened also in August, which is the public consultation on free zone entities closed on the 9th of August after an extension with a week. As a result of the public consultation, we expect further amendments to the free zone regime, given that many people have submitted their comments, and that therefore this is the perfect opportunity really for the authority to make a couple of changes. Today, we're going to be going from one ministerial decision to the other, really. So it's going to be a bit of a whirlwind. So brace yourselves. What we wanted to do is really in a soundbite communicate all of the information as much as possible to yourselves. What we see here, is a progressive scale with revenue progressing, where we see that very small businesses that have a revenue up to 3 million dirhams, they can avail the small business relief, therefore not pay any corporate income tax, and they can maintain their financial statements using a cash basis of accounting. Those are the only ones that can do so. Everybody else needs to follow an accrual basis of accounting, and everybody else needs to be following the IFRS standards. Up to 50 million dirhams of revenue, though, the smaller businesses can still use IFRS for SMEs, a slimmed down, easier version of IFRS. Entities that have revenue above 50 million, they need to maintain financial statements according to IFRS. So there's no exception to that. I will add in addition to this as well, is that for QFZP purposes, the free zone entities also need to have audited financial statements. If the entity has a revenue in excess of 200 million dirhams, then the entity, in addition to being required to have audited financial statements, it also needs to be complying with TP rules and documentation requirements, including CBCR. Perhaps important as well to note here is that even if an entity has a revenue below 200 million dirhams, it still is required to respect the arm's length principle. However, it is not subject to the documentation requirements. And then finally, entities that fall inside the scope of Pillar 2 or have a consolidated turnover in excess of 750 million euros, calculated in dirhams at approximately 3.15 billion dirhams. Those entities need to have audited financial statements, need to comply with TP rules, need to be filing a CBCR as well. And they will fall inside the scope of Pillar 2, which means that very likely they will be subject to a top-up tax in the UAE. Important here as well to note again is that the UAE Ministry of Finance last week has stated that it does not intend to implement the Pillar 2 rules in 2024 just yet. So we will likely see a 1-year delay with this. Moving on, we also had a decision published on pension and social security funds, where there you see that the ministry has stated that it believes it required a separate decision for public pension and social security funds, given that these would not necessarily fall within the sovereign exemption for entities. However, this exemption for pension and social security funds is also extended to the private sector. Now, this is only to the extent that these funds are set up for the benefit of retirement of private employees and their EOS, so their end of service gratuity payments. The private pension and social security funds, in order to be exempt, are subject to very similar rules. For example, they need to appoint an auditor that will, on an annual basis, certify that they still meet the conditions, and they need to meet certain conditions around the ring fencing of asset and income. The positive matter here is that for the purposes of the employer's contributions on behalf of their employees, those contributions, when they are done to a private pension or social security fund, in the sense of this ministerial decision, those contributions are tax deductible. When you look at, for example, a system that the DIFC has set up, which is the dues, which replaces the end of service gratuity and makes it mandatory for employers on a periodic basis to make a payment into the fund. Well, it's patterned after that, and those contributions will be fully tax deductible. It seems to me as well that on the basis of a reading of the ministerial decision, that anything in addition to end of service gratuity, for example, additional employer contributions, that will also be deductible. There are certain limitations, for example, entities where more than 15% of all of the contributions go to one single person, those contributions might not be deductible. That also brings us to an interesting topic, which is the provisions around end of service, which a lot of entities in the UAE have on their balance sheet. There's currently no clarity on the requirements for the deductibility or not for these provisions, whether they will be deductible or not. We will have seen, or you will have seen in the FAQ, that there's a statement made around provisions released after the effective date of corporate income tax, requiring corporate income tax to be paid on those provisions which are released, despite the fact that they were created before the entry into force of UAE corporate income tax. Moving on to a ministerial decision on the participation exemption, quite an interesting one. Yeah, the participation exemption sets certain conditions for a UAE entity to be able to benefit from an exemption on the income which is earned by way of a dividend or a profit distribution from a foreign juridical person, but also sets the conditions to exempt any potential capital gains, forex impairment, forex or impairment from a participating interest, whether that interest is a domestic or a foreign one. And the interesting thing in this, there's a couple of interesting things in this decision. Amongst others, that we see that when a participation, the cost of which equals 4 million dirhams, that is sufficient to consider that the minimum participation is met. So the minimum participation, which is normally set at 5% of the equity, interpreted in a broad way, is met. But there's more in that ministerial decision. Number one is that we see that ownership interests are defined in a very wide way. So it could be different types of equity, so therefore different types of shares, which would qualify for the purposes of the participation exemption. Whether you consider it as having an ownership interest or not is determined by accounting standards. An Islamic finance instrument may potentially be considered also as an ownership interest. There we place reliance on Islamic accounting standards. The ownership by members of a tax group can be aggregated to get to the 5%. So let's say that, for example, multiple members hold, So two members, for example, hold 2.5%. That means that you will get to the 5% minimum participation. What we see in addition to this, as well as the so-called subject to tax rule, requiring that the effective tax rate of the entity in which you participate as a UAE entity meets the 9% statutory rate, is that actually in terms of the subject to tax rule, we expand this to also situations where perhaps the statutory rate is not 9%, but if we calculate an ETR and the ETR is equal to or higher than 9% based on the UAE accounting standards, or if we recalculate the ETR of a foreign entity where that foreign entity pays taxes on a slightly different basis, still on a profit basis, if it meets the 9%, it would also meet the subject to tax requirement. What we see also is that there is a relaxation for the subject to tax rule for holding companies, as long as they earn enough of their income from participations, then as a holding company, it may be easier for them to meet the subject to tax rule. An important one as well in regards to the participation exemption is that for transactions, certain expenditure is not deductible. For example, if there's attorneys advising on an M&A deal, and that M&A deal leads to, for example, a capital gain in the hands of the sellers, then that expenditure is not deductible. Same thing, for example, if you advise the buyer, the expenditure is not deductible, but the expenditure can be capitalized together with the purchase price of the shares. There were also a couple of interesting developments around groups. If you might remember, in front of you, you see the conditions which are laid down for entities to constitute a tax group. In a nutshell, they need to be closely held, and closely held, that means that at least 95% of the share capital, voting rights, and entitlement to profits sits with the same entity, so 95% or plus. We cannot group any entities which are subject to a different tax regime. In other words, QFZPs or exempt persons, they cannot enter a tax group. And they, since we need to be able to compare apples with apples and oranges with oranges, these entities need to be subject to the same financial year end and the same accounting standards. When you meet those conditions, the parent company needs to apply for tax grouping and will do so on behalf of each subsidiary. It leads to a consolidation of the tax liabilities. As we will see on the next slide, there's certain specificities around the use of tax losses. But when it comes to tax grouping, the parent company is responsible for all of the filing and the payments as well of corporate income tax towards the FTA. And finally, the group is subject to joint and several liability, but which is something that can be ring-fenced. What did the ministerial decision say? It reconfirmed, for example, that we need to have a UAE parent in order to constitute a tax group in the UAE. This is important because this is relatively unconventional. In other jurisdictions, they will sometimes allow a foreign parent to be the common denominator between the different entities in the group. It also specified that the application to form or join a tax group needs to be made before a tax period ends for the purposes of the next tax period. It also reconfirmed the use of losses, and the use of losses is quite an interesting one because as a tax group, you could be operating two sets of losses, the losses of the individual members and the losses of the group. What do these rules say? They say that tax losses, they need to be used before we eliminate intra-group transactions. In other words, the consolidation cannot fully happen for the purposes of the member that has losses, as long as those losses, the individual losses, have not been fully used yet. And that those losses are subject to a same cap of 75% of profits, or the profits of the subsidiary itself. So capped until that threshold for the purposes of the deductibility. And when there's losses to be used, let's say that you have those two types of losses, the grouping losses and the pre-grouping tax losses of an individual entity, then the pre-grouping tax losses, they have priority over the grouping tax losses, and therefore they need to be used first. There are also situations where those pre-grouping tax losses for an individual member which entered the tax group can become the tax losses of the group. We have similar provisions also for carry forward interest, which is not fully used for an entity which later on enters a tax group. Similar provisions in the sense that first the carried forward interest needs to be used at an individual level, and only after that can the consolidation happen. Further, what the decision also states is that newly established legal persons, they can join a tax group from their incorporation if they are a sub of the group or a new parent. And it also states that for the purposes of the consolidation between for a tax group, is that we disregard transactions between the members, as well as valuation adjustments and provisions for transactions in between the different members of a tax group. Moving on to interest deductibility. The general rule stated on the screen there is that the interest deductibility is capped to 30% of EBITDA, with certain exceptions for specific let's call them money handlers, banks, insurance companies, where they are not subject to the 30% of EBITDA rule. The group cap, which is alluded to in the legislation, does not seem to be available just yet. And as a reminder as well, the disallowed interest can be carried forward and is deductible within 10 years. After that, the carried forward interest is lost. Specific interest deduction limitation rules or specific anti-avoidance rules exist for financial assistance between related parties, which I will spare you further comments on. What did the ministerial decision say is, number one, is that there's a de minimis threshold of 12 million dirhams, below which all of the interest is deductible. All of the net interest is deductible. So this is quite an important distinction. Only interest payments above 12 million dirhams are subject to the 30% of EBITDA rule. There's also an interesting couple of provisions around the fact that we are in a transition period, and it requires, as a result of it, to calculate EBITDA in a different manner, where normally you would try and calculate your interest before, so your EBITDA as the earnings before the interest, tax, depreciation, and amortization. For the purposes of interest, which is paid for historical liabilities held, which were prior to the 9th of December 2022, that's the date of the publication on the website of the Ministry of Finance and the FTA of the UAE Corporate Income Tax Law. In that case, we can add back the interest, which results in a higher EBITDA calculation and therefore a higher 30% cap on the interest. And there's another rule which states also that when there's instruments for which the terms were agreed prior to that same date, 9th of December 2022, that they are not subject to any limitations. Further, there's an exemption for qualifying infrastructure projects. Those would be projects which aim at the building of roads, utilities, energy. Those would not be subject to the 30% EBITDA cap. Very often, they're very, very important capex projects with heavy interest payments. So therefore, this is a very welcome relief. For Islamic financing, payments which would be economically equivalent to interest. You see that sometimes for Islamic financing, the product offered finds an equivalent in traditional or conventional financing. And when it does, we consider the interest as also subject to the 30% EBITDA cap. This would be an approach which is, for example, also followed from a VAT point of view. And on that interest, the concept of it is defined in a very wide way. You will see that certain fees, which you would not necessarily consider as being considered interest, are also considered interest, as well as certain amounts or fees which are paid to raise finance, guarantee fees, arrangement fees. Those are also considered as interest and therefore subject to the 30% EBITDA cap. Further, whether you are acquiring a good on the basis of a finance lease or a non-finance lease, the FTA requires you to identify an interest component, and that interest component is subject to the 30% EBITDA cap as well. And when we have Forex from interest, so the currency exchange on interest, that would also be considered as interest. There were a couple of interesting points as well made for unincorporated and foreign partnerships and family foundations. As a reminder, the unincorporated partnerships refer to clubbed together and simplified as partnerships, trusts, and foundations without an illegal personality. Those are not considered taxable persons, and therefore they're considered transparent. Transparency means that they are not subject to tax. In the case of the partnership, that means that the partners are taxed. In the case of the trust and the foundation, it means that the beneficiaries, that the tax regime needs to be analyzed in the hands of the beneficiaries. Now, there's certain rules laid down for unincorporated partnerships which are transparent, which require them to notify the FTA within 20 days of a partner joining or leaving an unincorporated partnership. When it comes to local branches of foreign partnerships, if you might remember, those local branches, they have a flexible regime where they can either opt to not be transparent or simply to be considered as transparent. They need to be making an irrevocable application for transparency. And if they have not, it means that the local branch is subject to UAE corporate income tax. In order for that transparency to exist for the local branch of a foreign partnership, that partnership needs to submit an annual declaration, and there needs to be in place a tax sharing information between the UAE and the country of incorporation of the partnership. When it comes to trusts and family foundations, which are clubbed together for the purposes of UAE corporate income tax, even though they have substantially different legal contexts, really. When you look at those, the requirement is for the entity not to be taxed, and for the arrangement not to be taxed, is that they don't derive income which would have been taxable if it was earned themselves. In a nutshell, for a trust and a family foundation, we need to look at the cabinet decision, which determines for natural persons whether they are in scope or not of corporate income tax. And that's a cabinet decision that I will get back to in a bit. There's also quite a couple of important transitional rules which apply. If you might remember, from the introduction of excise tax and from the introduction of VAT, the UAE's Federal Tax Authority has really placed a lot of emphasis on getting this right in the transitional period. And those transitional rules, they apply to immovable property, intangibles, and financial assets and liabilities. What does the stated principle say is that when those assets are acquired prior to the application of corporate income tax, there should be no impact on the calculation of corporate income tax. How that plays out for every type of asset is slightly different, really. We see, for example, that as a result of the transitional rules, an election needs to be made. And that's slightly different for a movable property, where we can make the election for each immovable property, or for intangibles and financial assets and liabilities, where the election needs to be made for all of the assets together, or all of the liabilities together. That election needs to be made in the first tax return to be filed by the entity, and its real tax impact, or rather the mitigation of the tax impact, is only going to happen in later years when the asset is disposed of or sold. This election is again irrevocable, so very important to consider in the first tax return. And when we look at the rules, there's certain periods which apply. For example, for the qualifying immovable assets, we need to look at the number of days it has been owned before the first tax period, but only up to 10 years. Give some examples to make this a bit more tangible. For immovable property, once we will hit the 31st of December of 2023, and you are basing your financial year on a calendar year, then we will head into the UAE corporate income tax system, which means the following. We need to look at the market value at the start of the first tax period. And what we can do is we can take the market value, and then as illustrated on this slide, take the higher of the original cost of the acquisition or the net book value, and then exclude the gains realized. Or for entities which are not selling the immovable good, we will consider as if it's been realized. So the gain to be excluded if I sell the immovable property in 2024, as you see on the left-hand side, is 70 minus 10, or 60. So the principle is here, I bought this immovable property before the introduction of corporate income tax, and therefore I will be excluding the difference between the market value and the higher of the cost value or the net book value for the purposes of calculating the gain. That's option number one. Option number two is to look at a day count, and that day count allows us to exclude the gain on a qualifying immovable property up to the point that the good was owned right before the introduction of corporate income tax. So if, for example, we assume a disposal value of 80 million and a original cost or the net book value of 10, which means again which means that I'm at a difference of 70. Then I will calculate the days I have owned the qualifying immovable property before the introduction of corporate income tax, to then divide that by the total number of days I've owned the qualifying immovable property, which in this case gives me a ratio of 89%, which means that from that difference of 70, if I multiply it with 89%, I get to 62, then that's the gain to be excluded. A relatively similar picture for intangible assets. Again, those intangible assets, they need to be measured on the basis of their historical cost basis. And I will be disposing of those intangible assets, or be deemed to be disposing of them, in the first tax period after the introduction of corporate income tax. Here, though, I only have the day calculation. So what I will have in 2024 is a disposal or a deemed disposal, in my example of 12 million. I will take the higher of the original cost or the net book value, in this case 7. The difference between the two is 5. Then I will look at the number of days I've owned the qualifying intangible assets before the introduction of corporate income tax on a calendar basis, divided by the number of days, total number of days I've owned the qualifying intangible assets, which gives me a ratio of 75%. So therefore, I will be excluding 75% of 5, or 3.75. Same thing happens to financial assets and liabilities. The slight twist there is obviously that in terms of liabilities, that is something from an accounting point of view very different than the assets. So the outcome also of the exclusion is different. Where for an asset, I'm disposing it, or I'm deemed to be disposing it at 25, and my historical cost is 20, then I have a gain to be excluded of 5. But I could have a market value disposal of my liability at 38, and my historical cost, or my net book value, is 35, which means that my exclusion is a negative exclusion. So therefore, it will be added to the taxable income. Moving on, we have some TP clarifications in a specific ministerial decision, which stated that the bar where I will put the requirement for a local UAE entity to have a master file and a local file at revenues earned in excess of 200 million dirhams. When that happens, the master file and the local file are compulsory. For most groups, the group would already have a master file. It's then a matter of having an additional local file by the time that you are subject to your filing, subject to your corporate income tax filing, that is. Also, entities which are in the scope of Pillar 2 are subject to the same requirements to have both a master file and a local file. When you sum that up into a table, you will find back master file and local file and what they consist of. You'll see that those two, they need to be provided to the FTA within 30 days upon request. Would want to stress that 30 days very often is insufficient to draft up a local file, so it's definitely recommended to do this much earlier. And the OECD format is expected to apply. We've seen that as well so far in the ministerial decision, that largely OECD principles are followed. There's an additional requirement as well, which is popular in this region, which is a disclosure form for transactions which are conducted with related parties and connected persons. There, this disclosure form needs to be submitted together with the corporate income tax return. Whether it's going to be a threshold applicable, such as we see, for example, in Saudi Arabia, or not, that remains to be seen, as well as the format as well, because this is not a prescribed OECD requirement. Natural persons conducting business, as repeated the number of times, the corporate income tax law in the UAE is actually a business tax law. The UAE has, by way of a cabinet decision, brought some additional clarity on who is considered conducting a business. And when we look at the different categories, we have on the right-hand side income earned from real estate. That could be through rent or a capital gain. That would not be taxed irrespective of how much, when the income is earned by a natural person, so not a company, and when there's no requirement to get a license for the purposes of earning this income. In the middle, the situation is similar, but not entirely the same. Again, when the investment income, whether that's dividends, interest, or otherwise, is earned by a natural person, it will remain untaxed. When there's a licensing requirement, then it will be subject to corporate income tax, as well as when it is in scope of the commercial transactions law, which I recommend everybody to read, because the scope is relatively wide, and therefore still it will put a number of natural persons in the scope of UAE corporate income tax. And then finally, when it comes to regular personal income from employments, such as, for example, salaries and bonuses, as long as so that's completely excluded, and then any other business income which is earned, as long as the revenue is below 1 million dirhams, then it will remain not subject to corporate income tax. Further, there were a couple of amendments made to the executive regulations specifically for corporate income tax. You will see that there's going to be a couple of tax authority decisions as well coming out, executing more of these aspects. But let me try and highlight a couple. On the top right, you see that there's a reconfirmation that when there's voluntary disclosures to rectify errors, but the error does not affect the tax due, the net liability, then there's still a requirement to submit a voluntary disclosure. So that's an important one. I would highlight Article 3 maybe as well, the record keeping period, 5 years as from the period following, from the year following the tax period. The bottom left, where you see additional obligations for tax agents, but also additional possibilities. Tax agents are no longer required to speak Arabic. They can also just speak English. And then perhaps, again, to the right of your screen, the bottom right, individuals can now request a reconciliation with the FTA before criminal proceedings are started for tax evasion. So quite an important one as well. Penalties have been made public for corporate income tax. You will see that they are not the same as for VAT and an excise tax. There's your classic failure to maintain required records, 10 to 20,000 dirhams of penalty. Not submitting documents in Arabic, 5,000 dirhams. Not deregistering, that can go up to 10,000 dirhams. Not notifying the FTA of, for example, a change in your legal structure, that can go up to 5,000 dirhams, and not notifying the FTA of the appointment of a legal representative is 1,000 dirhams. A very important one is the failure to settle the payable tax, where there is going to be a, and I quote this, monthly penalty of 14% per annum. What we expect with this is that there's going to be a monthly penalty applied. So we're going to be dividing 14% by 12. So that's quite an important one. It is not as high as for VAT or excise tax purposes. So we will continue to see for VAT and excise tax purposes a much, much larger types of assessments. Equally, submitting an incorrect tax return is only subject to 500 dirhams penalty. Submitting VDs which result in the disclosure of an error will additionally attract a monthly penalty of 1% on the tax difference. And when you neglect to submit a voluntary disclosure after being notified by the FTA, then you'll get a fixed penalty of 15% on the tax difference and a monthly penalty of 1% on the tax difference. If you don't facilitate the tax auditor during an audit, you'll get a penalty of 20,000 dirhams. And if you do not, or in a late manner, submit make certain submissions to the FTA, then you can get a monthly penalty of 500 dirhams and 1,000 dirhams as from the 13th month after the violation. For qualifying investment funds, there's a couple of additional rules which have been made public. For example, if the fund is held by less than 10 investors, then we cannot have one person holding more than 30%. If the fund is held by more than 10 investors, we cannot have one person holding more than 50%. So those are important ones which would prevent funds to be qualified, but yet to be potentially partially or fully privately held. But the same decision also requires that an investment manager is appointed with 3 investment professionals, and that the investor is not involved in the daily operations. For QIFs, there is no mandatory requirements to meet the ownership interest ratios for the first 2 years. Essentially, this is a period in which you can build up your financial track record. We need to keep evidence of the investor's intention. If the requirements are not met, the exempt status will be lost as from the third financial year, and it will be impossible to regain the status later on. When we look at REITs, or real estate investment trusts, and there's a couple in the UAE, there's requirements around the minimum level of the size of the fund. You can see that the value of the real estate, excluding, for example, land, needs to exceed 100 million dirhams. In addition to that, at least 20% of the REIT needs to be floated on a stock exchange, or the REIT needs to be held by 2 or more institutional investors, provided that they are not related parties. And this might surprise you for a real estate investment trust, but there's a requirement that minimum 70% of the value of the fund is invested in real estate, because some of the funds value could be invested maybe temporarily also in non-real estate matters. Guidance for a registration. A couple of important points is that irrespective of the fact that you might be registered for VAT and perhaps excise tax, you're still required to register for corporate income tax purposes. Legal persons who will only derive exempt income are also required to register for corporate income tax purposes. The qualifying public benefit entities or non-profit associations, those are going to be able to register for corporate income tax as from the 1st of October 2023. Even businesses that perhaps don't meet the VAT threshold or do not conduct the activities in scope of excise tax, but which are within the scope of CIT, they need to register for CIT purposes. Certain persons are only exempt after obtaining the FTA's approval. That's the case, for example, for qualifying investment funds and real estate investment trusts. And even small businesses are also required to register for corporate income tax purposes. And on that note of the small businesses, if you might remember, it's the ones that earn, so income cannot exceed 3 million dirhams. The small business relief only runs until at a maximum the 31st of December 2026, or any tax period which ends before the 31st of December 2026. If an entity wants to apply the regime, it needs to make an election. The small business does not need to keep TP documentation, given that the threshold is put at 50 million. Any QFZPs or Pillar 2 companies, so subsidiaries of a large multinational entity with a consolidated turnover in excess of 750 million euros, are excluded from the small business relief. And the small business relief applies irrespective of the VAT status of the small business. A couple of other updates as well. Since the 1st of July 2023, any supply of goods and services through electronic portals and where there's an order made online and the value of those sales made by the portal exceeds 100 million dirhams, then the VAT needs to be reported per emirate. You might remember that prior to that, it was applicable irrespective of what was the value of the supplies made. Now there is a specific threshold set, which is 100 million dirhams, which is quite helpful because it excludes the smaller players. Just as a note, it still applies if you have multiple branches in multiple emirates. You're still required to report per emirate. Couple of other important updates for the UAE. As from July 2025, we will see the adoption of e-invoicing in the UAE. The Ministry of Finance and the Federal Tax Authority are expecting a very important impact on the filing for VAT purposes of e-invoicing, and are expected to do much more with the data that they are going to be collecting as a result of this. That was the UAE. I'm going to be covering KSA still, the wider GCC and international as well. international developments. What Zatka did is recently published a deregistration guide, which is quite helpful because very often a deregistration is not always the easiest process to do. But it also published a list of commonly litigated points, which are quite interesting if you are preparing for an audit, for example. Then you can see that these are the most commonly litigated points. It doesn't mean that they're the points that Zatka mostly audits, but those are the ones that are the most commonly litigated. Zatka also, since the 1st of July 2023, now 5.5 years after the introduction of VAT, now requires for the sale of second-hand cars, the profit margin to be applied for VAT purposes. In a nutshell, this means that we deduct the purchase price from the sales price and that we calculate VAT inside the profit margin realized by the sellers. This is going to mainly impact showrooms and second-hand car dealers in Saudi Arabia, where it is important that new cars, imported cars, or cars which have been used, for example, in the UAE, those would not be eligible for the profit margin scheme. There's specific requirements for the invoices as well for profit margin goods. For example, the tax invoice needs to specifically refer to the fact that it's a profit margin tax invoice. And for example, as well, we will need to include the chassis number of the vehicle which is purchased in order to identify that the vehicle is secondhand. A couple of other amendments to the VAT legislation. Some are sometimes slightly amusing. For example, online stores need to display their VAT registration in a manner visible to the general public. I'll leave it up to yourselves to judge how one should do that. Conditions for a government body to be considered as sovereign and not to be conducting an economic activity are now included in the implementing regulations. For international transport, we now have the 75% rule embedded in the legislation rather than in a circular. In addition to that, and this is the first one in the region, we now see a 0% VAT rate on supplies to diplomatic missions. Before this change, this happened through a refund mechanism. In addition to that, when there's write-offs, we need to now have a certificate from a certified account to claim the VAT back on VAT debts. And finally, the threshold for one to file a voluntary disclosure is now 15,000 and no longer 5,000 in Saudi Arabia. There's very important updates to the ruling process as well. And the ruling process now also allows non-registered tax persons to apply, as well as non-residents. Now, there seems to be a suggestion that we can also ask questions around registration. Regretfully, the timeline for the issuance of the rulings is gone. It used to say 45 days. What's still in there is that a customer cannot apply for a VAT ruling on behalf of the supplier, except if the customer is required to apply the reverse charge mechanism. And what we also see is that the specific provisions around Zatka being able to open tax rulings or spontaneously publish general clarifications on specific topics for the purposes of the taxpayers. Very important is that there was a public consultation, and parts of that public consultation have already been implemented. As it often goes in Saudi Arabia, the final implementation of the law is very often very close to the initial public consultation. What will interest you specifically is the bottom half of the slide, where, and more specifically, the bottom two notes, where the Kingdom has reduced the withholding tax rate for technical and consultancy services and international telecommunication services from 15% to 5%. And has also clarified when it comes to flight tickets that the 5% withholding is only for flights leaving Saudi Arabia. So this is a very important aspect, really, which greatly reduces potential drawbacks, but which still needs to be read together with the double tax treaty, which potentially applies between Saudi Arabia and the country that you're analyzing, because most of those treaties would simply say that insofar as the foreign entity does not have a PE, then no withholding taxes can be applied. Also, e-invoicing Saudi Arabia is almost at the end of its project, because now it is targeting entities that have annual revenues over 50 million SAR. Those entities are now entering the second phase, and they need to be linking their systems with ZATCA as from the 1st of February 2024. That should say on the slide. They should link their systems through the Fatura platform. Those who are in scope, they will be notified by ZATCA themselves. A couple of technical provisions as well around the real estate transfer taxes, and notably on the exemptions there, which require, for example, natural persons which are divesting from a company to hold on to their real estate for 5 years in order to claim the exemption. And we also have additional exemptions between group entities, which apply so that we can more easily transfer real estate between entities of the same group. Important as well in Saudi Arabia is that the tax amnesty has been extended until the end of the year. I would say extended again. That amnesty requires that the principal tax that is settled, when that is the case, then ZATCA will waive the penalties. Those are for violations prior to the 1st of June 2023. You see a couple more specifics on the slides. Two quick updates from other countries in the region. Number one is that you might have read in the newspapers that the Minister of Finance of Bahrain has declared that Bahrain plans to introduce corporate income tax, and it plans to do so once the consensus is reached on the global minimum tax framework under Pillar 2. Once that happens, Bahrain will also, like the UAE, like the other GCC countries that are part of the inclusive framework, adopt policy measures to adopt Pillar 2. The only country which is not a part of the inclusive framework to implement Pillar 2 is Kuwait. So the minister has said that Bahrain is currently analyzing options and is in an ongoing consultation project. Additionally, and not too different from the dynamics under Pillar 2, Qatar has amended its executive regulations under the income tax law, has, amongst others, modernized its PE definitions, as well as its definition of PE taxable income. When we say modernize, it's align them with the most recent OECD recommendations around this. Certain tax exemptions are implemented as well. There is added powers for the GTA, for the General Tax Authority as well, and there's certain amendments also made to the economic substance rules, which Qatar also has since quite some time. There are also updates on the contract reporting requirements, but which I've spared you in this in today's webinar. Quickly, a couple of words around international updates. BEPS 2.0, which consists of the two pillars, Pillar 1, Pillar 2. For Pillar 2, more commonly known as the 15% global minimum tax, there's been a couple of documents issued in the last couple of months. Amongst others, administrative guidance on the model rules that was issued in July, Though that administrative guidance is going to trigger a amendment to the administrative guidance of earlier this year. There will be a consolidated version later this year. That guidance is very important for the implementation of the rules. Additionally, it has released more information on the Globee information return. That's, for lack of a better word, the tax return under Pillar 2. And has also made progress in the development of certain documents, such as model rules for the so-called STTR, or subject to tax rule, which requires a certain set of payments to be taxed at least 9% in the country of the recipient, in order for the country of the source not to make a withholding. So those are quite important documents to be studied. And then probably the last important topic, as well as that, we see a bit of a rebalancing between the different institutions from a tax policy point of view, where the UN wants to play a more active role in international tax, essentially giving voice to a number of countries that have felt insufficiently represented at the OECD level and have felt like their interests have insufficiently been taken into account. And there's a couple of proposals made by the UN, such as one multilateral convention on tax matters, whereas currently we're mainly dealing with a whole set of double tax treaties, a non-binding multilateral agenda, so a more inclusive one, and a framework convention on international tax cooperation. I appreciate this was quite long for a lot of you, including for myself as well. So let me have a look at the questions that were put in the Q&A box, which are quite a bit. So I'll try and take my time in the next 10 minutes or so to try and go through each and one of them. And if you have any questions in the meantime, please do add them still. I'll start with Shokat, who's asking if an individual owning real estate transfer all to a foundation, will the foundation be exempt from corporate tax where there is no corporate entity involved? That is indeed the case. We have assisted many clients so far in transferring their real estate to a foundation. There is an attention point in regards to the transfer tax with the land department when speaking about Dubai, for example. But that can be negotiated. But indeed, if the real estate is currently held by a regular LLC, whether that's an onshore or an offshore vehicle, it will put the income from the real estate in the scope of corporate income tax. Asif, for Saudi, indeed, it's for technical and consultancy services before a 15%, which applied. Yeah. That is correct, and indeed what was stated on the slides as well. There's an anonymous person who is asking about the Emirates-wise reporting for e-commerce. So as to aggregators, the complication is the following. The UAE has taken a certain position as to what the liability should be of the aggregator, and it notably applies principles which are not too dissimilar from the European Union to identify the platform or the aggregator as the entity liable for VAT rather than the seller using the aggregator or the platform. Let me go through the other questions. Is the UAE tax law segment of the webinar concluded? Yes, it is. Mohammed, advising on financial product services considered part of wealth and investment management services in order to be qualifying activities in a free zone. It's a very good question, Mohammed. This is not a defined term in the ministerial decision, which is a bit problematic. We are facing multiple issues with the interpretation of those terms, especially when we compare them to the types of licenses issued by the DIFC, ADGM, and the like. We don't see a perfect fit for this, so this is probably pending a further clarification from the FTA. Council member fees or director fees earned by a natural person or beneficiary is considered as employment income. It's not entirely clear just yet, Musada, but I do expect that this will be the case. I would also note that those payments are subject to an additional requirement, which means that for connected persons, they need to be at arm's length in order to be deductible for tax purposes. Shiha, as to the master file and local file threshold, so it seems that it is, I believe, applicable to the individual entity. Now, if you would have a group in the UAE and the group meets the 200 million threshold, then I would consider that it is it also puts you inside the scope. Moving on, dormant legal entities are indeed required to register for corporate income tax purposes. Assad, this is a common question around the 10,000 dirham limit. It's a bit confusing, but it seems that it still exists as well, which is a bit confusing to reconcile with the federal tax procedures law. But indeed, let's say that you have done a wrong Emirates-wise reporting, then it still looks like you do have to make a voluntary disclosure. Dilber Hassan, I think the main update from the Ministry of Finance forum is that the UAE will not be implementing a UAE top-up tax, so not a QDMTT, neither an IIR in 2024, but likely 1 year later. Also, there will be a public consultation early next year for UAE companies, where we'll be able to make certain suggestions as to the implementation of UAE corporate income tax. Harsh, the QFZP regime and the participation exemption. I don't think there's a specific hierarchy in the law, but I would consider that there's a double guard really for the receiving of dividends, because indeed the holding of shares or securities is a qualifying activity. Jamie, there's penalties for being subject to an audit and getting a request to submit documents in Arabic and not fulfilling that request. We have similar provisions for VAT purposes, but actually what we see is that those are never applied. So it's something to keep in the back of the mind, but likely will not materialize. Someone's asking a Meydan office in the mainland, whether it satisfies the substance requirements. I think the bigger question for a office in the mainland is whether potentially it is a permanent establishment in the mainland, which it most likely is indeed. Ahmed, as to the amendments to the KSA withholding tax rates, there is indeed no statements made as to what happens to any other payments. So those continue to be to apply really, and I agree there can be also debates around those. We will need to see a bit, but it is a stated intention of Zatka to reduce the financial burden of entities investing into Saudi Arabia. So I don't believe that we will have additional issues, scoping issues between technical and consultancy services and the other types of payments. Anonymous person is asking the impact of an incorrect tax return. Will there be room for appealing on grounds of different interpretation? There will definitely be. It follows the UAE Federal Tax Procedures law. Joy athletes winning prizes or sponsorship fees, are they subject to corporate income tax? I would say that it depends on their corporate structure, really. There's certain ways in which we can structure around this in order to make it a bit more beneficial, but it also has ramifications from an international tax point of view as well. So those are probably a couple of points to take into account. I'm trying to, there's a lot of questions. Loss carry forward question by Rian. Once corporate income tax applies, indeed, tax losses can be carried forward indefinitely, and they can be set off up to 75% of current profits. For RAC, ICC, and JAFSA offshore companies, they are indeed considered as a resident as per UAE corporate income tax, and they are taxable on their worldwide income. For Emily, if the parent company is in Germany and subsidiaries in the UAE and there's consolidation done in Germany, you will actually need separate financial statements for the UAE as well, specifically for the UAE entity. The consolidation in Germany is insufficient for the purposes of this reporting. Krishna is asking on TP. The group head office is outside of the UAE, and the annual turnover above 200 million euros, I would assume, at a UAE group level. Do we have to have a local file in the UAE and master file in the Brussels office? So usually if you consolidate a turnover at a Brussels HO level is higher than 3.15 billion euros, then you would be considered a Pillar 2 company. So then indeed you need your local file for the UAE. Your master file, which you're using in Brussels, you can still use for the UAE as well. Is it a good idea to move to mainland? Free zone entities, they can opt into UAE corporate income tax. If you opt in, certain reliefs and exemptions are available. So it really depends on your specific situation. I would say additionally, when you're subject to tax, then foreign tax credits are available. Access to treaties is easier. So those are a couple of considerations there. Shweta, dormant entities are indeed required to register for corporate income tax purposes. I'm trying to go from an anonymous person on the withholding taxes in Saudi Arabia. These actually do not apply. Well, you need to accrue them when there's services rendered, but as long as they're not paid, it's not triggered. So whatever potential withholding tax provision that you have in your accounts, which currently would be 15%, if the payment is made right now, since the 12th of September, then the withholding tax rate is going to drop to 5%. So lots of questions. Let me try and take a couple of more. For let me go back up. Anonymous is asking if a group of companies are planning to form a tax group, should they first register companies on an individual basis? They should indeed first register on an individual basis, and then later on the FTA is going to allow the tax grouping to be made. ADGM foundations are indeed legal persons. Will they be treated as a taxable person? Well, they could be treated as an unincorporated partnership. When they're treated as an unincorporated partnership, they are not subject to corporate income tax. For the beneficiaries of the foundation, if those are individuals that otherwise would not have paid corporate income tax on their income, then those would also be not subject to corporate income tax. Emily, for the foreign tax credits, those would apply to potentially both withholding taxes and corporate income tax incurred in another jurisdiction. Harsh, I think for the active trading of shares, I do think that it will qualify as a qualifying activity. As to the amortization of goodwill on consolidation, so far the UAE follows IFRS completely with no deviations. So insofar as it's deductible for accounting purposes, will be considered as deductible for tax purposes. The only exceptions that apply are the Articles 26 and 27 for no gain, no loss, and the transitional provisions where there's certain exclusions from the amortization. And then Harsh, we should probably talk the director's remuneration. It's very hard to benchmark it. There is no public data for this. You can only really rely potentially on internal comparables. If you have unrelated directors or unrelated staff with a certain salary level, that's a good internal benchmark. And other than that, I would recommend to be conservative and maybe to consult some of the public surveys granted by certain headhunters, for example. I propose that we close off. You can contact me on thomas@aurifer.tax if you have any questions. Feel free to reach out, and I hope you found it beneficial to run through all of the changes of the last couple of months. I'll also be adding the slides on our YouTube channel, so you can have another look there. Feel free to subscribe and feel free to follow us also on LinkedIn. Many thanks, and wish you all a very good day. Bye-bye.